I'm going to get started. I'm Katie Rice with Guild Mortgage in Truckee and Tahoe. We do loans in California and Nevada, and we are so excited to have you here today. I know it's springtime and almost summertime, so our message today I think is very apropos. And Chelsea will go ahead and introduce everybody. Most of you know my partner, Chelsea Combs. She has been with me for over 8 years and done thousands of loans with me. And we'll be doing the introduction. And we have Shelby who put this presentation together. We also, I see, have Tim Cussum on the line, who has been with us for many years and does all our pre-approving and talking to lots of our clients. And Kelly Garrison, the famous processor for us, is also on the call. So, sorry about that. I'm going to let Chelsea take over here.
That's Rue, our honorary team pet. Hi, everybody. Thank you for joining us. We are really excited. We have Pacific Premier Insurance here. So we have Todd Cooker and Erik Matzenbacher. So I know everybody here feels the pain that we're going through with the insurance. I just had some clients cancel a contract for getting a $12,000 premium on just a regular house, So hopefully this is going to be really valuable, and I'll turn this over to Todd and Erik.
Thanks, Chelsea. I'm gonna see here. Let me share my screen and get this presentation up. Let me know when everyone can see this. Is that visible? Got it? Okay.
Yes.
I can't hear y'all, so thank you, Chelsea. Appreciate that. All right. For anyone who's not worked with us, let me just do a quick overview of who we are and why we're qualified to speak on this subject. So we are an independent insurance agency based in California. In 2021, we insured over $500 million in real estate in the Tahoe Truckee area alone, and more throughout the rest of the state. Our focus is on high value home insurance, commercial real estate, including apartments and shopping centers in these tough to insure areas. We were also named by expertise.com as one of the top 20 homeowners insurance agencies for 2022. And with that, I will turn it over to Todd Cooker, who most of you have probably worked with at some point, to explain the goal of today's presentation.
Awesome. Thank you, Erik. And thank you, everybody, for taking some time. I want to go over just kind of some of the goals. I've been on a lot of these calls lately, primarily as a listener. Most of them have to do with state legislation, long-term outlooks, funding from Sacramento for wildfire effort reliefs. All of that's really important as part of the conversation. But what I really wanted to focus on was what we can do for you today to help you and your clients right now. These long-term solutions are very necessary, but they don't affect your ability to transact real estate right now. So to that point of your buyer backing out over a 12K approval, that's kind of what we want to deal with. What can we do right now to help ease those concerns? So our whole team's dedicated to that specific thing. What can we do right now? So let's hop into the agenda. The agenda for today, the first thing that we're going to have up is our 3 buckets of coverage availability. This section is going to explain how the size of the property is going to affect the buyer's insurance options in today's market. So a little bit of a rule of thumb for you so you know what you're getting into based on the size of the structure that maybe your client's looking to purchase. The California Fair Plan and what they didn't tell you will be up next. This section is going to highlight potential pitfalls with the Fair Plan, specific contractual items, things like that you might not know, and how we can help your clients avoid them. Best practices will be up next. These best practices are going to allow you to differentiate yourselves as market experts and provide a smoother transaction experience, and hopefully that'll lead to repeat business and referrals. New tools. There's a few new tools that we have that you can help leverage. They're free programs that'll help you differentiate yourselves again as those experts in the community. And then finally, if time permits, we'll open it up to Q&A. If we run out of time, don't worry, we'll make sure we share our contact information. I saw everybody logging on. I know a lot of you, so you have my contact information potentially. And as always, we strive to be a resource for you and your clients. So we'd be happy to answer these questions, whether it's during Q&A or whenever we have time. So,
And Todd, we'd be happy to let everybody have your contact information. We'll send that out afterwards as well. And then if you do have questions, putting them in the chat is a great way, and we will make sure that those get answered for you.
perfect.
Great. So the first thing that I think we have to make clear is that reconstruction is really driving this conversation. So as most of you already know, insurance companies are not as interested in the market value of the home as they are in the actual reconstruction value of a home. So what is the difference? Well, let's just take a home that sits right on the lake and compare that to a similar sized home with similar building materials and similar site access, but located somewhere less desirable. The market value for these two properties might vary wildly, but the reconstruction of the actual structure itself will likely be comparable. Remember, insurance companies do not rebuild the view or the lot after a fire. Like you say in your profession, it's location, location, location for market values. So now that we have that point underlined about what we're actually dealing with here, Todd, would you explain more in detail the availability that you're seeing for homes of different reconstruction amounts?
Absolutely, yeah. So, in our experience, working with all of you, we're going to have the most insurance options available when the subject home can be rebuilt for between $500,000 and $750,000. These are going to be your smaller bucket. Okay, so at this point, there's usually multiple standard insurance carriers that we can still get to bid on the account. The next stop is for homes that fall between, on a reconstruction scale, between $750,000 to about $2.6 million in reconstruction. For these homes, we'll generally have access to the California Fair Plan and several non-admitted carriers. So we'll have additional options, but same as the smaller bucket, we're going to start to lose out on some of the standard options that were available to those smaller homes. So again, the larger we get, we start to lose some of those available options, but still have many for this middle section. And at this point, you may be asking yourself, well, why is that? Like, wouldn't the insurance company want the nicer, the bigger homes? The reason for this change in our world is really focused on one area, or saturation. Think about having too many eggs in one basket. Risk management works by spreading risk. When an insurance company takes on too much risk in one specific area, they stand to have catastrophic losses that are just not sustainable. And so lastly, that brings us, we have homes carrying larger reconstruction dollar amounts. So for these properties, the California Fair Plan is just not a viable option in our opinion. We'll explain that in the next slide as to why that is. But all you really need to know is that we have multiple options for these buyers from, $2 million all the way up to $20 million in reconstruction value. So again, I worked with some of you on different occasions for different size properties, but we have some solutions for any of these three buckets, but all the way up to, again, $20 million for the biggest lots on the lake potentially. So.
Yeah, and just to contextualize this a bit more, I mean, when we look at things in the insurance industry, like for example, after 9/11, the World Trade Towers, that was not one insurance company on that risk. So the way that we would insure something like that is there'd be layers of coverage with different insurance companies. Maybe the first 50 million is insured by insurance company A, the second 50 million by company B, et cetera. So, and again, it's just how many eggs can we put in one basket? Insurance needs to really spread risk around. And we're not meaning to call any home small or anything. It's really just buckets of small, medium, and large in terms of reconstruction and the availability that's out there. So at this point, it's worth diving a little deeper into the California Fair Plan, because in my experience, there are many misconceptions about what this is and is not. So the first thing I want to mention is that the stated goal of the California Fair Plan is to shrink in size. A couple years ago, the Fair Plan amounted for 1% of home insurance in California. That's doubled to 2% in the recent years, which may come as a shock, since probably most of the properties that you're transacting on at least have to consider the Fair Plan as an option. I also want to note here just an anecdote about a state that's kind of been through this and come through the other side, so to speak. Florida experienced a similar set of circumstances in 2004, 2005. In 2004, there were 5 named hurricanes that made landfall, and the collective wisdom at the time was, well, that'll never happen again. The next year, there were four Cat 5 storms that did an aggregate damage of 1.72 billion in property destruction. Citizen, which is the Florida equivalent of the California Fair Plan, if you just substitute the peril of wind for fire, you're basically there. They became the #1 insurance company overnight. At that point, at one point, I should say, they made up 27% of the state's market share. So there is some precedent for concern here, but the story is also informative in how Florida's consumers took steps to change how they viewed insurance. And Citizens now accounts for only 8.2% of market share, which is still significant, but far less than they were at the peak. The reason I mentioned, the reason why this is such a big deal to the insurance industry, and why in our estimation, the California Fair Plan wants to shrink and make it difficult to write business, is because the Fair Plan is essentially financially backed by traditional insurance companies doing business in the state based on their market share. So if, for example, let's say State Farm and Farmers write 25% of the home insurance in the state of California, they would also be responsible for making up 25% of any annual yearly shortfall that occurs with the Fair Plan. When you see the Fair Plan requiring tough underwriting application requirements or taking large rate increases, this could be a big reason why that's happening. This also may give context to when people say the California Fair Plan's claims process can be challenging, which is why understanding the contract and pitfalls that customers have has such a big impact on one's experience. For example, the California Fair Plan has an 80% co-insurance clause, which simply put means if you insure your home for less than 80% of the reconstruction value, the California Fair Plan can enforce a penalty. And I know that was probably confusing what I just explained, but if Todd if you would take people through an example of how a claim paid out with co-insurance penalty, that would be great.
Yeah, I'd be happy to. So, so in this example, we'll have a home, and let's assume that it can be rebuilt. The reconstruction value here is $4.5 million. Unfortunately, the homeowner decided to take a $3 million California Fair Plan policy, despite having the 80% co-insurance clause. So here's the problem with that. The home was only insured for 67% of the actual reconstruction cost. At the point of a claim, the client would only receive $2,010,000 to rebuild a $4.5 million home. Not to mention, they would then subject any deductible from the $2 million figure. And again, not to mention, they'd have zero coverage for personal property, alternative housing, all of the other things that go along in the Fair Plan to make sure that their claim goes smoothly. So this penalty, it's not exclusive to the California Fair Plan by any means. Many insurance companies include it. It's literally a penalty designed to dissuade people from trying to reduce their insurance costs by not insuring properties to value. The actuarial math that insurance companies use, it works, but it's only as good as the data that gets entered. If property values are not accurate, then the premiums are not accurate, and therefore the reserves will not be accurate in the event of these large scale losses.
And I can't see everyone's faces, but I promise we're not going to ask you to do any math today, and that's about as deep into the numbers as we're going to get. I just want to, this is such an important topic to explain, because I really don't think people understand what they're getting sometimes with these policies. And just high level, let's pretend this scenario occurred with a loss that wasn't for the full value of the home. Let's say it was only 1/10 of the home. Let's say a $450,000 loss, for example. Well, people think they have $3 million in coverage, but the co-insurance clause will apply to losses of all sizes. So in that scenario, a $450,000 loss, the homeowner may only receive $201,000, and that's subject to deductible. And that's why the details here are so important. I just don't think that people who sign up for these really understand necessarily what they're getting into. They think they have coverage up to the $3 million, and that may not be the case. There are other insurance groups out there too, I'd be remiss if I didn't mention this, that are offering what they say are excess policies to the California Fair Plan to take it up to $4 million. However, that does not change the structural co-insurance penalty built into the FAIR plan. So we do not offer those plans. And the reason is simply, we just think that some of the issues that could present themselves are pretty obvious.
Yeah, and you know, piggyback on that, like I mentioned previously, there have been some recent changes to the California FAIR Plan. So they now require portions of the $3 million limit to be used for coverage called ordinance or law. So it's no longer they can use the full 3 million, even if they wanted to, on just insuring the structure, like in our example. So what they can use for the structure is even lower. And ordinance or law is really important, though. I mean, we don't mention that in the way that it should be overlooked, but basically as a result, because of the percentage that they require you to place there, buyers are really capped out at about $2.6 million for any primary structure with the FAIR plan. So the last thing I'll mention about reconstruction costs is that they can vary when thinking about traditional costs versus reconstruction after a wildfire. So setting aside debris removal and the other factors that differentiate those two. So, you know, the difference between knocking over a candle as an accident and just one home burning down versus a, you know, catastrophic fire where 200 structures in a small area are lost. We see massive swings of costs of labor and materials after wildfires due to hyperinflation, or in our industry, it's called demand surcharge. Everyone's already experiencing inflation, but this could be an added expense. So suffice to say, you want to account for reconstruction costs of all types in your projections. We've got a producer now on our team. Some of you have started to work with as well, Maria. She lived through the Paradise Fire, and she personally fielded 200 subsequent wildfire claims. She can attest firsthand to the challenges that occur after reconstruction, but really more so to the importance of having a well-rounded policy. So making sure that there has been money set aside for loss of use for housing for sometimes in excess of 3 years, or personal property, or all the other important parts. A lot of times the $3 million limit gets thrown around, you know, verbally, like the FAIR plan is $3 million limit. And basically, again, with these new requirements, now that number's knocked down to about 2.6 of what they can put on the structure. But even then, when you start to break off pieces of that for important areas like ordinance, loss of use, things of that nature, you know, the size of home that they can responsibly insure is, you know, adjusting.
And look, we understand going deep is the last thing we want to do is bore you with insurance jargon. We just like to communicate that we deal with this stuff every day, right? So we're on the calls, we're taking calls with the carriers, we're working through the minutia to help your clients, and we really want to make you look like the hero in getting the transaction closed for having the best team in the business. In my opinion, real estate is a dynamic community relationship business. And it takes having A players on your team who know how to craft a deal to make it all come together, especially in a hard market like this one. So Todd, can you speak to some of the other ways we help be a resource to our channel partners?
Yeah, sure, of course. So one of the first ones, I've tried to get this information out in different channels, the border realtors and some others, but we've got the Firewise accreditation program. So for any of you that don't know, this is a sub-community focused discount. And it's available to any owner that's within one of these Firewise areas, one of these sub-communities. And the idea behind it is pretty simple and tangible for most folks. It's one home can only be discounted so heavily. You can only do so much mitigation at one property. If neighbors on both sides and all the common areas don't look so great, but yours looks, you know, fantastic, that's challenging. So these sub-community focused discounts, basically areas that have come together to uphold mitigation requirements for each individual owner, but also the common areas and areas like that. So like, for example, North Star, Dollar Points, areas like that would qualify here. The next one that we like to share with best practices, and I'm sure all of you are a bit familiar with this, is the California FAIR Plan photo requirement that is now being forced upon us. We recommend taking photos of the front, the back, and the address number. So front, back, and address number. It's just 3 that you need of any property that your clients are considering while you're at the property. The California FAIR Plan is requiring these images, and most recently, they're now specifically declining applications where the photos have been gathered from the common real estate websites like Zillow's and places like that. So we've received inquiries as to why we can't use pictures from the internet. We get a couple guesses. One would be they could be dated and not communicate, precisely what the underwriters want to see. Sometimes we get those photos from Zillow and, there's no snow on the ground and we're putting an app in December, something like that. Or two, like we discussed earlier, the FAIR plan, they're not looking to grow. So sometimes challenging requirements are, can adjust. So the best practices is just, again, it's taking the photos. It only takes a couple minutes while you're at the home. And all that does is it speeds up your client's process and also makes sure that you won't need to make a separate trip no matter what. And then lastly, we've got Firewise lists. So on our first point there, the Firewise accreditation program, we've backed into the information. We've broken down every eligible sub-community within every county of the entire state. So we can provide you with a free PDF list for whatever area you want just upon your request. So just shoot me DM and just let me know what areas of California you commonly work in. Obviously, we've got the Tahoe Truckee list, but anywhere that you commonly work in, or you think, or someone or something like that. Many of the realtors have had success marketing their listings, as what we're being told, as potentially as Firewise to help ease potential concerns of some of the buyers, making their listings seem more attractive. So that'll bring us into some of our new tools that we've got for everybody. Again, a lot of you have seen some of these. One is our easy application link. We know everybody, including your clients and yourselves, are super, super busy. So we've tried to, and we think we've successfully made an application process that's just painfully easy for your clients to apply for coverage. They can complete our proprietary application from a cell phone or a laptop. It's been completed by thousands of prospects at this point, and on average, it takes about 5 minutes and 20 seconds to complete. Within 2 business days, they will be presented with a fully underwritten insurance option presented by real human beings. So we don't just email your clients a generic option with, do-it-yourself instructions and how they can buy coverage themselves and expect them to communicate everything with their lenders and all the parties that are involved. We've got experienced staff who are available to help answer these specific questions to make sure that they're comfortable. And then once they're ready to move forward, we're here to support you all, your escrow teams, and just shepherding everyone through the insurance portion of the process. So that's our application piece. And then now we've also recently released our PAC Premier Market Watch. So this is a great one. We mentioned earlier at Pacific Premier, we're uniquely positioned in California because we have so many solutions to present for fire issues, and it's constantly changing as far as carriers that are in the market, out of the market, that sort of thing. With our PAC Premier Market Watch program, clients can opt in to have us check back in with them and bring new options and recommendations to their attention when those changes occur.
Todd, they were asking in Nevada, are you doing anything in Nevada or is this all California?
We are licensed in Nevada as well. And the concerns, it's not very far away, obviously, as you all know, and the concerns can be different given the area. So some of the questions, I'm sure the way we'll answer a lot of the questions that may come in just a second are going to be kind of California focused. So the answers could be a little bit different for the Nevada folks. But if anybody wants to reach out specifically, if you just tend to do more transactions on the Nevada side and you want to know specifically how that might be different, we can answer those. I guess just reach out and we'd be happy to answer those.
Yeah, some of this is specifically a California issue because the insurance is fragmented and fractured by state. So California has its own Department of Insurance. And all the carriers have to comply with the Department of Insurance rules and regulations. And some of the regulations that have been put in the last few years have put insurance companies in a position where they have to make a tough call. And usually that results in, if they can't take the rate that they need to justify the fire risk, then they will narrow their market and only take business in certain areas, which is kind of what I think a lot of you are experiencing on the California side of in Lake Tahoe. But yeah, we can dive into all that. That is it for our presentation. I'd just like to add really quickly that Tahoe has a special place in my heart, as it does for many who have visited. I spent much of my childhood in Incline in Tahoe City. My family still runs Rosie's Cafe right there in Tahoe City, and I've witnessed firsthand the growing challenges of the insurance market over the last 13 years since I entered the insurance industry. For my friends and family who are in the area. My team and I are determined and committed to the long-term protection and preservation of this wonderful one-of-a-kind place. Insurance is only one piece of the puzzle. There's a lot of work to do, but I'm certain it's worth it. I'd also like to extend my gratitude to Katie and her team for encouraging and hosting this discussion. I'm sure some of you have additional questions, and if we do have time, we would love to take inquiries. That said, our information is on the board there, our application link, our email for quotes, phone numbers, websites. And at the bottom there, you'll see a footnote. I should mention we list our social media here, and I just full transparency, we're kind of an old school office, but I think we're slowly getting better at this. We kind of enjoy talking with folks one-on-one, but we are trying to keep people informed on social media as well. We understand that is something that people want. And so if you want to take the time to like us on Facebook, Instagram, or LinkedIn, or whatever your preferred platform is, we promise we will not spam you with anything that is not information and important data-driven content. So with that, we will open it up.
Yes, please put your questions in the chat or come off voice and or mute and go ahead and ask your questions. I know a couple questions that we did have is like, we have a lot of people who, and a lot of agents who the clients want to shop for their insurance. And obviously there's a certain time in the contract that they're allowed to look, but it's not very long. And so we need to have it for our underwriting. So we ask that it start happening right away. Can you discuss that a little bit, Todd, or Erik, about what you think is the best practice for an agent when, a client wants to shop insurance? Because I know it can cause an issue for us as lenders to wait while they do all this shopping, and we can't have them shop after it's been underwritten. We need to get the docs out, so we can't have them continue shopping, and that sometimes is what happens.
Yeah, I'd be happy to answer that. So we've, like we mentioned, we've tried to boil this down to be the quickest, easiest version of that. So for anybody that does reach out, we make it a point to have an option to them within 2 days. If they're continuing to look outside of that, because that doesn't necessarily mean that's the only option they want to get, or that sort of thing, we're going to make sure they have it really quickly so you have what you need. If they're comfortable enough with the solution, we can proceed and make sure that we're connecting with, and again, we've worked with anyone who's local, and then all the national type escrow and mortgage offices as well, to communicate what's going on back and forth. There are some challenges. It's always good to note, depending on the size of the home, over shopping, you could say, could be potentially a challenge when the insurance companies receive 4 or 5 different applications for the same applicant. Again, some companies do it a little bit more digitally, and it's not going to be a strike against the client or concern or anything like that. But there are some companies, specifically when you get toward the higher end of coverage needs, that there is concern when there's too many applications received, the information's different on one application to the next. When we're looking to, kind of negotiate and obtain the best terms of coverage, we want to make sure that we're putting our best foot forward. So a lot of times we have the local know-how. Like we said, we did about $500 million real estate around the lake last year. So we know the markets to approach. We do it very quickly and efficiently. We would generally recommend to any client reaching out to us if they want to get options. We usually just say, hey, you know what? If you could just give us 2 days, see if you like it. And if you like it, great. We'll shepherd you through the whole thing. And if you don't, you still have, time, but that way we won't be bumping into anybody. They'll know exactly the companies that we've, went to and presented for them. And that way they can avoid any of those potential issues or pitfalls, getting declined for too many apps, that sort of thing.
Awesome. Because you look at different insurance. So you're not just looking at one like State Farm, or just you're looking all over the place for that specific property and client.
Yeah, exactly. And Larry Payton has a question in the chat that I think kind of dovetails with this. But yeah, so there are a number of insurance companies that we're approaching, and it changes every day. I mean, someone might pull out of the insurance market while another one comes in. So we could rattle off a couple of carriers that we're working with predominantly right now. Some of it's different from the commercial market to the personal market. But like Todd was saying, I think the most important thing is, if you're in the market for shopping for insurance, interview a few insurance agencies if you want to, but then land on one and let them do the work, because what we're really trying to do is communicate a story to these underwriters. We have relationships with the people who are ultimately making these decisions of whether or not they're going to be able to place the risk and take the insurance on. And so from our perspective, it's really helpful if we can say that we speak for you, and we can mean that. And we can really negotiate and tell them your story as to why they should insure this property as opposed to another one that they may be looking at. I mean, underwriters are people too. They have stacks of paper on their desk. A lot of this stuff is getting moved to AI, which is making it more challenging, I think, not less. But to the extent that we are able to tell them the story of the property and the people buying it, I think that's helpful.
So I'm not sure if that answered Robbie's question. When a homeowner has insurance in place and wants to up the value, is there a risk of getting canceled?
I don't think that there's a risk of being canceled for that. I would absolutely advise that they should attempt to do that. I mean, we've seen building costs increase so dramatically that to not do that out of that risk, if the insurance company is not interested in staying on that as a result of the value going up, then I think it's just not a good fit. Like we were talking about the co-insurance piece of this. I mean, not being insured to value is its own risk. There could be a penalty imposed if you have those types of clauses, and there's a lot to that. You could have a policy that waives co-insurance. You could have different replacement or actual cash value loss settlement provisions. But I wouldn't advise anyone to kind of bury their head in the sand and not want to broach that subject with their company.
Yeah, and I'll sort of piggyback on that. We have seen carriers where they kind of like we had explained in those examples where there's just different companies prefer different size homes, if that makes sense. There are companies that may have issued or insured a property or policy with a specific dollar amount in mind, and if the owner wants to up it over a certain amount, they may say it's generally not a cancellation. It's just more to what Erik spoke about. They're going to get the feedback of, no, we're only going to give you $500,000. And even if the owner says, no, I'll pay more, it's going to cost $1 million. I talked to my realtor, I talked to the builders, it would cost $1 million. And the really unfortunate part is some of the feedback we get, sometimes they're trying to convince, people to remain with that option that they know is a little bit dated and doesn't really fit what they're looking for at that point. So yeah, I think it's less of a cancellation risk, more of a probably just not a good fit type of a situation.
Yeah, we see that more in the commercial markets. There will be a cap that they can have for any one building, and if we hit that limit, and usually we know as the agency, we know about that in advance. So we might have that conversation with the client before we even approach the carrier. But I think transparently, I would just say, if it's no longer going to fit this carrier's mold, then we just need to find the next best alternative. And usually we have, a couple that are competing for this, and it's not too much of a big change when we do that.
And then Janice said, personal property, how does that affect rates and also high-end finishes?
That's a great question. So personal property is a separate bucket of coverage from the structure coverage or some of the others. So depending on the carrier, there's different options. So like we talked about in the presentation there, the FAIR plan has sort of like a total bucket of funds that you can break apart, right? And that's going to be one of the areas where you're filling. So a person who has $1 million worth of personal property that does like those really high-end finishings, that sort of thing, it's going to be more of a concern for them just because they're going to be kind of eating away quite a bit at those limits. If somebody has that amount of personal property, they're likely someone who should be interested in maybe a carrier that can supply different types of coverage potentially too. So, but then also you mentioned high-end finishes. And another thing that we're seeing up there a lot is just renovations or improvements to properties. So another thing that maybe is a good thing to reference is small improvements generally don't need different types of insurance policies. If someone is going to purchase a home and they want to put their touch on it, their fingerprint a little bit, and do some new backsplashes and maybe, countertops or something minor like that, that's not generally too much of a challenge. But if somebody buys a property and really puts a lot of work into it, that's going to be, vacant and a full crew for, 3 to 6 months, that sort of thing. One, you generally do need a different policy in order to have coverage for that period of time. So kind of a construction type policy, course of construction, builder's risk type policy. So that's one that's just a contract situation that's important to know about. And then two, there are, just like the co-insurance clause, a lot of clients are familiar or have heard about maybe their policy including an extended replacement cost where they can potentially bump up coverage in excess of that. But one caveat to that coverage is that if you ever adjust your finishings or you make renovations, generally it's over $5,000 is the way it's stated in most contracts. If you make an adjustment of more than that, you're required to let that insurance company know within 30 days of the change in order to maintain eligible for that. So again, just different levels of concern there with the higher end stuff and the higher end properties that a lot of folks around the lake like to enjoy.
That's good info. And we had talked about, I don't see any other questions right now, but we had also talked about a lot of the big carriers are now requiring different types of alarms. Could you address that, for what kind of alarms? You had kind of answered my question on that, but I just thought that was a good information for a lot of clients to know.
Sure. So most of our carriers at this point are not requiring alarms. So almost every carrier is still discounting for mitigation practices like burglar and fire alarms and different things like that. So almost all of them are giving discount for those items. As far as requirements are concerned, most of them are not. There are certain carriers that do require it. Different things can adjust it. So based on the occupancy, some carriers, if it's a secondary home where they know you're less likely to be there when these things occur, might require it, versus if your primary home, you're present there all the time, they're less concerned about it. Differences in that regard. And then Erik, in terms of mitigation, I don't know if you want to chime in with just it being a good mitigation practice.
Yeah, sure. I mean, I think it's two separate conversations. One is, is a carrier going to require it? Maybe not. And, we can place coverage without that. But do you want it? That may be another question. I mean, I think these recommendations are made for good reason. And just touching back on one topic that we mentioned in the presentation, what happened in Florida with hurricanes and how they went from 27 with the state-run exchange to 8.2%. Was really just a shift in the consumer's mind of, hey, what is insurance for, and how was it being used prior to that? So, I mean, you kind of have I know that people feel like you pay for insurance and you don't get anything from it, and I totally respect and understand that perception is out there. But really, insurance is meant for like an insurmountable, like the challenges that we're facing, like wildfires. So if you can keep, and what the constituents of Florida did, I mean, keeping a deductible higher, having risk mitigation things in place like burglar alarms, like smoke detectors, like these different things, so that they could avoid having small claims on their record. That allowed them to not look like they have a frequency of claim issue, and they have the good protection with a good carrier for if there is a hurricane in Florida. And I think that's really where California will ultimately trend. Consumers in certain areas especially will look at, hey, I have a good solid carrier that is stable. I want to keep them. I'm not going to file the $2,000 claim. I'm going to carry a deductible that is, maybe $5,000 if that's affordable to you. It's a different conversation for every person, and that's why it does help to talk to a human when you're reviewing these quote options. What's the break even on this? Just like people in the mortgage industry look at, do you want to buy points to get your rate down, for example, and what's the break even on that? It's the same conversation for insurance. If I'm telling you to look at a high deductible, is the break even 10 years out if you're guaranteed a claim, or 30 years out? That's the kind of advising and conversation that Todd's having with clients every single day to make those decisions. But ultimately, you want to keep the number of claims on your record down so that you can have that good company when you really need it. And that's when you have a serious claim like a wildfire or a major flood in your home. It makes a difference.
And then Janice again said solar impact on coverage.
Yeah, that's a good question. Definitely. I mean, these are all things. You make a change. You want to work with an agency that is sort of hand in glove. When things change, you want to have a representative that you can just shoot a quick email to and say, how does this affect my insurance? If you don't have that relationship with your agency now, take down our contact information. We'd love to talk to you. But that's, I mean, anything that you're adding or putting onto your home is going to affect the coverage amount. And we just need to account for it, but it's not a problem in terms of getting insurance or covering the solar panels. It's just, we're not clairvoyant, and we need to have an open line of communication with our clients.
I had a question. So for our realtors, if they have a listing coming up and they are concerned that there might be some issues, is that something that they can vet with you guys ahead of time, or do they have to have a buyer in place, the buyer to be combined with the property to get any kind of info on that?
This is one I prefer when they reach out. Now, as to answer your question, giving specific to the penny quotes without a buyer is a little bit of a challenge, but we are so familiar with the area and the available options. What we can generally do is just have a quick chat to sort of let them know the magnitude of the risk given the location. Right. And what I mean by the buyer is the person going to vacation rent, or are they going to live there primarily? Or is it going to be a secondary home? Like, all of these things can change the company that'll ultimately approve them and the rate that they'll pay. So without the buyer, we can't get to a specific dollar amount. But if the realtor reaches out and says, one thing we would generally do is we can do it for them, or generally just point them to the Firewise list, like the list I was talking about, the PDF list. One is just point out, if you're in one of those communities, that's a very good first step. Whether or not you're marketing for that, or the seller's agent just wants to let the buyer's agent know, or again, it's just information, but knowing you're in one of those communities is a very good start, because like Erik mentioned, like all these mitigation efforts they're all taking hold, but at different speeds in different areas. So if you're in one of these areas that has really just gone for it in terms of mitigation and is as up to date as possible, it's good to know. And so if we can see the location, they can give us a property address, give us some of the particulars. We can generally provide them, again, just kind of a range of where we think it'll land, what the costs might be as an estimate. But more importantly, what that does is it just lets them know, like to your point, when you said you lost the deal because it was a $12,000, purchase, if we can foresee the cost to some extent, roughly, or the risk level, that may help you all sort of like phrase how you're bringing this to your clients, sort of attention, or, how an offer gets written, or just any of those things. Just some of that information up front might be better if there is a concern of, what the cost would be for insurance.
Or just have you find the right buyer, before you're 25 days in. I mean, that's the worst, right? So, and I think that, and I want to just back up one moment too. Like, we write the California Fair Plan all the time. I'm not knocking them at all with what we're trying to describe. I think the biggest thing that we're trying to say is just for some homes, it's based on the size and the reconstruction of the home. It's either fit, no fit. And I think that's just, to be transparent with clients is important. You want to understand if it's going to work for them or if it's not going to work for them. And a lot of that comes down to just how much it's going to cost to rebuild the home in this instance. But the good news is we have options all the way up to 20 million.
And didn't you say you were working on a 40 million one as well?
That was a
real estate
commercial. Thank you, Katie. That was an amazing transition and plug. This is like a career for you. This anchoring thing, huh? This is good. No, we were working on a shopping center in Lake Tahoe, and so their costs were $40,000 a year. It was going up to $120,000 a year. And we were able to find a solution for $28,000. So they were very happy. It was a pretty high dollar, but in commercial, obviously you get higher dollar amounts for reconstruction. We're working on one down in San Diego right now. That's 88 million. So I mean, it's all over the board. The costs are all over the board. There's a lot that needs to happen in the state in terms of don't know if anyone saw this, but Cal Fire put out a great photo the other day of what defensible space actually meant to this one home. I mean, you could see the fire marks all the way around the home, but they had defensible space, and so it protected this home. So there's so many things that we need to get done to protect these amazing areas, but we're trying to just do our part in terms of making sure that insurance is still available and eligible for the people who live there right now. Don't want people to get priced out of these areas.
Well, we really appreciate you coming and talking to us about it. It's obviously something very on all our mind, and we don't want any clients or agents losing deals this summer because they don't have the resources. So everybody, we highly recommend you do reach out. I love, Todd, that you're allowing people to reach out beforehand, because sometimes that will help with the agent being able to direct that they've already kind of vetted at least the property. So
Yeah.
thank you. And if anyone has questions, we will be sending this video. We do have a YouTube channel that we have put all these on as well. And we do this because we really want to help clients. We want to help you. So please think of the RISE team when your clients need financing. We really appreciate it. We want to be able to continue to offer these valuable things so that we can all help each other grow in 2022. So thank you all.
Yeah, thanks again for the opportunity. This has been awesome. Great.
Yeah, thank you, everybody.
Thank you.
Thank you guys, all of you.
Thank you.
Have a great rest of your week.
Thank you.
You're on.
Bye, Al.
Thank you.